I'm just going to get the agenda back up. Give me a second here. All right, I'd like to call to order the February 28th VCBB meeting. Board members in attendance. Let me get back to the screen. We have Laura Sibilia, Holly Groschner, Brian Otley, Patty Richards, and Dan Nelson will not be in attendance today, I understand. Staff, we have Christine, we have Rob, we have Stan, and Alyssa. Okay, just make sure. I'm like, Alyssa, I don't know that we've, did we do the formal meet and greet yet for the board?
Maybe not, like a brief, yeah. I mean.
Sorry if I am not recalling. There's so many things going on that it's hard to keep it all square in your brain.
No problem.
So let's get started with the meeting. Get back to agenda. So we call the meeting to order. Approval of the February 14th, 2022 minutes. And we also have February 18th. Is that correct? February 18th is a special board meeting we had on Friday the 18th. So those meeting minutes are in our packet as well. I do have changes to the February 14th meeting, but let's take a motion to approve February 14th minutes first.
So moved.
Minutes. You have a second. Brian seconded. Discussion. I just want to make a change to the minutes of February 14th. Under approval of Maple Broadband pre-construction grants. Noted in the last 4 paragraphs, I'd like to make some changes to what has been written. It says in the 4th paragraph from the bottom, Patty and Christine confirmed it was relatively little. I did not state that. Christine, you may have stated that, but I would like for that not to say Patty confirmed it was little. And also, where it says Laura Sibilia commented that this sets a high bar, and board discussed that all the CUDs take this approach, it would be almost $3 million investment. The $3 million investment was my back of the envelope calculation, so I would just like to reflect that piece that Patty noted that if all CUDs had similar marketing budgets, it would be roughly a $3 million investment. Just $3 million investment. I would just like to make that change. And then the last piece is that I voted against the motion, not in support. And that's a significant change.
Okay, duly noted.
Okay, so with those changes,
we have one more change as well.
Okay.
On page 7, the date is February 18th. As opposed to January 18th for the special meeting.
Yeah, let's take those meeting minutes second. We'll do those next.
Okay. Oh yeah, sorry about that.
No worries. So we're voting on the February 14th, 2022 meeting minutes with the changes that I noted. Is there any further discussion?
Holly has her hands up.
Holly?
Hi. So at the in section Roman 7, at the bottom, I can't tell what bottom is that. I guess it's the bottom of page 3. It says that I highlighted the importance of establishing the regulatory position as a provider to access federal subsidies for assistance. I don't know what the rest of that sentence means, but if you put a period there, I'll own it.
Okay.
Okay, duly noted.
Okay, is there any other information to change that board members would like to bring up, or staff for that matter? All right, hearing none, let's vote on the motions as amended, or the motions and minutes as amended. All those in favor, please say aye. Aye. Any opposed?
Aye.
Okay. All in favor? Yes or yes. No opposed. Minutes carry. The second set of minutes is listed in our packet as January 18th, 2022, and that should be February 18th, 2022, as Brian noted. So I'm going to move we approve the minutes. There's a second of January 18th.
Second.
Second, the discussion is we're going to change the date from January to February. All those in favor say aye.
Aye.
Aye. Any opposed? The ayes have it. Both minutes are approved.
Yeah, we also need to approve the agenda for today's board meeting.
I'm sorry, I did skip over that, didn't I? All right, let's take that. I'm going to move we approve the agenda as submitted today by Christine and staff. Your second?
Second.
Second.
Excellent. Any discussion? Hearing none, all those in favor of the agenda say aye. Aye.
Aye.
Aye.
None opposed. Agenda carries, and now we can continue. Next item up on the agenda is bond bank presentation and question and answer session. Christine, I'm going to tee that up for you to lead.
Yeah, thank you. And so we have a guest here, Michael Gahn, who's the executive director of the Vermont Bond Bank. And the Vermont Bond, as Michael will clarify, while the Vermont Bond Bank specializes in general obligation bonds, not necessarily revenue bonds, Michael has quite an extensive background. So as Rob and I talked to Michael, we thought he could present based on his experience as well. So we asked him to provide some of his experience. And so at this point, I'll hand it over to Michael.
Thank you, Christine, and nice to see everyone and meet you. My name is Michael Gahn. I'm the executive director of the Vermont Bond Bank. I've been here about 4.5 years. Prior to that, I have a background in community development finance, as well as investment banking and public finance. In that first role, I worked with basically have worked with communities at all ends. Bond Bank is a AA+ rated entity, and I obviously have worked with the Bond Bank, but then going back to my banking days, worked with entities that were either unrated or low investment grade, to sort of have a understanding of the spectrum of credit and the ways in which they interact with the market. So I think that's kind of relevant for this discussion. Christine had asked me to present, so I've prepared some materials, not knowing exactly what the knowledge base is of all the members on this call. They're fairly broad, but have tried to highlight some things that I think are relevant. So apologies if it's redundant or too sophisticated for that matter, but I think it sort of hopefully strikes a middle ground here. So with that, I will share my screen. Oops, that's not the one. There we go. Okay. Okay. So I believe you all should be able to see my screen now.
Yes, we do. Yep.
Great, thank you so much. So to kick things off, the Vermont Bond Bank, I kind of joke sometimes that I feel like we're one of the best kept secrets in the state. We've quietly done really important work for about 50 years. The purpose of the organization is to, provide access to capital and low-cost capital at that for governmental units around the state. We do that by issuing bonds into the capital markets, the municipal bonds. We then use those proceeds to make loans to communities all over the state, school districts, towns, villages, cities, fire districts in some instances as well. What's I think relevant and important for this conversation is that under current statute, we can only either purchase a general obligation bond from a governmental unit, or in the example that it's a revenue bond, it needs to be a defined municipal utility. In practice, about 99% of our portfolio is our general obligation bonds. But even those few legacy revenue bonds, generally benefit from monopolistic power. And so that was something that came up a few years ago when the statute was being looked at with regards to the ability to use general obligation bonds for broadband. And then, because we have a limited exposure and limited interaction with revenue bonds, really a lot of what I'm discussing here is from my own history working in the municipal capital markets. To round things out here, just to give you a sense of the bond bank and our scale at which we operate, we range, depending upon if it's pre or post principal payment date, for our underlying loans, from about 550 to about 600 million in loans. The 60% of those or so are for local government, and then 27% for school districts. And then in addition to this, we also do work with the state's clean water and drinking water revolving loan programs, which adds, we're kind of the fiscal administrator for that. So that adds about 240 million to our to the number of loans that we look over generally. So getting more into municipal bonds specifically, I've shared these materials and they'll be out, but I'll summarize here. The general concept is that a specialized market has developed around municipals primarily because of the tax exemption. So, interest on the bonds and to some degree capital appreciation, but not all of it, is tax exempt. Not those earnings are not subject to taxes. And so then you have kind of a specialized market that's developed alongside it. We'll talk about ownership in a second, but it's fairly unique in that you have a lot of individual investors of one type or another that participate in the market, which is a little bit different from other types of fixed income, like corporate bonds, for example. The tax exemption itself is given to units of government or instrumentalities. And then there are some categories of private use bonds that have been deemed, by policymakers to be worthwhile for tax exemption. 501c3s are a form, like hospitals, educational institutions, a form of private activity bonds that can benefit from the tax exemption. Those are not subject to something that's called volume cap, which is a limit on how much of a certain type of private activity bonds can be issued. Private activity bonds subject to volume cap are things like what VSAC does with student loans, or Vermont Housing Finance Agency with housing bonds. Those are subject to volume cap. What's relevant for this conversation is that under the infrastructure bill, a qualified use of tax-exempt bonds was expanded to broadband. And, to the extent that you have 501c3 or CUD exclusively participating in the transaction, it may not necessarily be relevant. But if you have, say, like a private entity that may be operating the system or may somehow benefit from the use of the system, other than just the general public, this becomes relevant. And I can talk about what that means kind of at the end of the presentation. So one point here is just that though they are tax exempt, certainly municipal bonds can be issued on a taxable basis, which can sometimes help out with, it gives you more flexibility. There's some strings attached to tax exemption in terms of reinvestment rates you're allowed to invest any sort of bond related proceeds in. Yeah, as I mentioned, the use of the proceeds, and then you have disclosure requirements as well. Taxable bond issuances don't have as many restrictions as far as the use of proceeds or their reinvestment rates, and that's actually been an increasingly large segment of the municipal bond market after tax reform in 2017. I'm not sure. So I think this is relevant in talking about because it just lays the baseline for why people are interested in different types of bonds. In a vacuum, you would expect tax-exempt bonds to trade to sell at their taxable equivalent yield. So just for example, if you had a 35% marginal tax rate, you'd expect them, that's a little over 7% or so as compared to a 5% tax-exempt yield. In reality, that doesn't necessarily happen. Because of the relative thinness as compared to, say, treasuries or corporates of the municipal market, or expectations about increasing tax rates or other sorts of things. So one thing we look at is the tax-exempt indices as compared to the taxable treasury indices. And this gives you a sense of where things have been historically. For most of the last decade, they were right around 100%, if not a little bit lower. So, that's very attractive for investors because they're getting a little bit more than they would expect to get if you were just looking at things on a purely tax equivalent basis. But what's been really unique post-COVID is that ratios have really plummeted. And this is important because it speaks to the mismatch in supply and demand in the current market and the appetite for different types of credits, even those that are lower rated. So to back up a second, the municipal market generally, it's about 4 trillion. That's shown in the upper left-hand graph here. About 450 billion or so in annual issuance. That's primarily revenue bonds. Actually, GOs are about a third of the total issuance. In terms of what bonds are being issued for most of the last decade, it was evenly split between refundings and new capital projects. Over the last couple of years, it's been a little bit more slanted towards new capital projects, which is interesting. And then finally, holders, as I mentioned, individuals are a large portion of the market, which is why some of the disclosure that comes alongside municipal bonds is important, because at the end of the day, it's not necessarily going to be large corporations or institutions that are holding the bonds. It's individuals who are less sophisticated of an investor. That gives you a sense of who owns municipal bonds on the bottom right there. Okay, I'm going to get into now the kind of current market, and then we'll transition our way into broadband specifically. As I mentioned, we've got, for the most of the last 2 years, we've had a pretty significant supply and demand imbalance. Post this giant giant decline right here are outflows from municipal bond funds, and then this giant spike right here was a spike in interest rates due in March 2020 as the pandemic became a reality.
Excuse me, Michael.
Yep,
I'm going to ask you to just hold for 1 second.
Yep.
There's a lot of background noise. Somebody's cleaning out some drawers or cupboards, maybe reorganizing their kitchen. I'm wondering if, Rob, if you can mute everybody except Michael.
Sure, let me see. I'm actually not seeing anybody that isn't muted but Michael and me right now.
That's some cool multitasking, Michael.
I promise you it's not me.
Okay. Well, let's try it again, and I'll see if I have anything coming up here, and if for some reason we'll figure it out.
This is a scintillating presentation. I don't want to miss a word.
Well, that's very generous of you. So the basic story is after COVID broke out, there was basically like kind of a liquidity crunch on municipals, and that's what caused this spike in rates. People wanted to get out of munis, they wanted to get into cash. The Fed stepped in with a facility that was actually never used, but gave the market a lot of comfort. And after that point, we were at all-time low rates. The bond bank has had our issuances in the summer of 2020 and then the winter of 2021 were the lowest of all time. And we've been hovering right around those rates ever since, up until the past month or so, when sort of the inflationary environment has caught up with the market, and there's been a significant increase in rates over a relatively short time. But if you look at the chart here on the bottom right, from a historical perspective, we are still at very low rates. And if I was to show you a broader history, that would even drive the point home further. But certainly post 2008, we've been at historically low rates, which is kind of the running joke in the finance community. But nevertheless gives you a sense of where we are. So again, what that means is this supply-demand imbalance, as well as the ratios of high-quality tax-exempt bonds to taxable bonds, means that folks are looking for yield. Credit spreads are low. And as a result, there's been a lot of interest in what we call the high yield sector. So this is low investment grade, an investment grade, by the way, is BBB minus, is the lowest investment grade rating. So this would be BB plus and lower, or unrated. So that's called the high yield market. And what is shown in the upper right-hand portion here is a graph displaying returns on high yield bonds in the gray, as compared to just general munis in the orange. And you see over these various periods in which we've had very low rates, high yield outperforms because there's a little more yield in them at the time of issuance, and then we've had a generally declining rate environment where they appreciate more. The bottom line is that the rates that you are receiving on high yield municipal securities that are tax exempt is very low. So this shows you on the bottom left here an indication as to where the rate environment was at the end of last year, and stripping out Puerto Rico, which is considered high yield but is its own sort of beast. You see there that you have high yield rates in right around 4%, which again, historically, we'd consider that to be pretty darn good for what is a 30-year investment. So that's of relevance to, like, there's probably representatives on here, but to the EC fiber transactions that have occurred over the last couple of years. Despite the fact that they're unrated, they've received pretty good rates. And certainly you could imagine a world in which some of the broadband issuances to come enter this market. I think it remains a question as to how well how much high yield interest will continue to exist once rates rise a little bit. But we've been saying for a long time that we thought rates were going to rise, and they really haven't. And what's going on, what has continued into the first part of the year, as shown in this upper left-hand graph, is that credit spreads have continued to narrow, meaning that generally pushes people towards more riskier types of investments. What happens with the Fed raising rates in this sort of picture is a little murky right now. Okay, so that's kind of the end of the portion of this discussion that's on the muni market generally. It's probably a decent point to stop, and then I'm in the event there are questions, and then I'm going to get into broadband issuances more specifically. Okay. Hearing none, we'll move on. Oh, I did add one more slide. Well, we are kind of getting into the broadband, but once you make the decision to go into the market, you have a number of ways in which you can sell a debt offering. The ones that are sort of bracketed here are those in which you're doing what's called a public offering. And what's important about that is that you are you're almost always using an underwriter who is the investment bank that essentially buys the bonds at one price and then sells them to investors at another price and receives a spread for that work. They put their capital at risk so that you are guaranteed to receive the entire amount that you need to build your project. And that's why they get their money, as well as the relationships with the investors that ultimately purchase the bonds. That spread is called takedown or underwriter's discount, just in case that ever comes up again. Within the public offering world, there are two methods by which you can do it. Sort of a plain vanilla public offering is what we do here at the bond bank. We have a rating, we have what's called an official statement. That's the offering document. We use a negotiated type of sale where we work with an underwriter who has discussions with investors leading up to and including the day of sale. Then we agree to a price for the bonds and we sell them. That works well for higher rated types of transactions. There's also a limited public offering where you have a limited offering memorandum, which was the case. Well, I can't remember if EC Fiber was or not, but generally this is what you use in unrated or high yield types of transactions. You're only offering the bonds to sophisticated investors, what are called qualified institutional buyers or accredited investors, and those are defined terms by the SEC. So the idea there being that those, given there's more risk in these bonds, you're really only offering the bonds to people that know what they're doing in terms of taking that risk. With both a public offering and a limited public offering, through the underwriter, the SEC gets involved. What's unique is that under the Securities Acts that followed the Great Depression, municipal securities were not regulated like corporate securities are, for example, but the SEC gets in there through the underwriters who are under their purview. And so what they require you to do is have ongoing and public disclosure that's posted on the Municipal Securities Rulemakings Board's website. So that would be things like audited financial statements, operating statistics in some instances. In really sort of difficult credits, you might have updates on construction or even quarterly financial reporting. And then that's the world of public offerings. You can also have tax-exempt municipal bonds that are placed outside of not using an underwriter and not using a public offering through, say, a direct placement with a bank, or even a private placement where you are negotiating directly with one investor. And sometimes that has an offering memorandum, sometimes it does not. So that's sort of the universe of how you place the debt when you go to market. Versus, say, a bank loan, some of the benefits of a capital markets transaction, so this would be a public offering, are as follows. Number one, you have, banks don't like to take on interest rate risk. So they don't really love to make loans more than 7 to 10 years, although obviously in some instances they do that because the rate environment is just so unclear and they don't want to have an asset that's underperforming. But in the capital markets, all transactions, there is no such thing as, well, that's not entirely true, but for the most part, you always have term and amortization that are matching up. And you can get very long financing for 30 years or in some instances over 30 years. You have an investor base that is more interested in cash flows than it is the value of the underlying collateral. So they're going to really underwrite the cash flows versus the, say the value of the asset. And that's relevant for, developing systems. You also sell away tax risk. So if there is a change in the tax code, say the highest marginal rate as it was a few years back was just near 40%, and now it's near, I think, 37%. Investors own that tax risk, whereas if you did a private placement or direct placement, there are some instances in which you would have catch-up payments due to the investor. And then finally, there's a pretty standardized optional redemption in the muni market of 8 to 10 years. So after 8 to 10 years, you can refinance the bonds without penalty. So those are some of the pros. The cons are that, you have to wait 8 to 10 years to refinance the bonds on a tax-exempt basis. Under current tax law, you're not allowed to refinance those tax-exempt bonds prior to 90 days prior to the call date. That was a change made in 2017. there's pretty high transaction costs, and there's also pretty high technical and knowledge barriers. So small transactions are not as efficient um, versus doing a small transaction with a bank, which is fairly straightforward. And then again, as I mentioned before, you have this high level of disclosure that's required in a public offering.
Hey, Michael.
Yes.
Yeah, this is Patty. What would you define as small?
It really depends, but just for kind of back of the envelope, say 8 to 10 million.
Thank you. That's helpful.
It also depends, sort of the sector you're working in. So, like for example, I did work in Pennsylvania. There are like a crazy number of units of government in Pennsylvania, like I don't know, like 30,000 units of government. And so you have a really specialized market that's focused in what are called bank qualified offerings in Pennsylvania. So that's less than that's an issuer that's not going to issue more than $10 million in any one year. And they get special tax treatment for banks, but that's a really developed market in that segment. And so they could do a $4 million deal that would price very efficiently because it just, they do it all the time. They sort of know the process. But for something that's more unique and more bespoke, that's not going to be a very efficient number. So just add that caveat to it. So I did spend a little bit of time looking at broadband bonds that are out there in the marketplace, and this is, I'm sure I've missed stuff. There isn't sort of like I tapped our financial advisor in our investment bank that we typically work with, and there's some databases of all municipal bonds that are issued, and there isn't like a category keyword for broadband necessarily. So I was hoping to have some numbers in terms of volume, but basically I think this gives a decent overview of the types of security structures that are out there for broadband. So on the general obligation side, so basically, there's either revenue bonds or there's general obligation bonds. Revenue bonds, you are securitizing a specific stream of revenues. And then general obligation bonds, you're pledging taxing authority essentially in really kind of like broad strokes. Within general obligation bonds, just because you're pledging your tax base doesn't necessarily mean that behind the scenes you aren't intending those bonds to be self-supporting from user fees or something of the like. So one example in New Hampshire, our colleagues at the New Hampshire Bond Bank do work with some towns that have issued general obligation bonds and then have contracts with private entities to operate and collect fees on the system. They had to issue those on a taxable basis, but nevertheless, it provides an example of a structure that's out there. It's a little difficult to get into the weeds on the Kentucky P3 deal, but definitely they did lease appropriation bonds that were not subject to appropriation. So they sort of guaranteed that they'd be making availability payments on this very complicated build out of the Kentucky system. But nevertheless, that's a good example where they've essentially used taxing authority to backstop a project for broadband. And I'm sure there are other examples out there. More common in the few in the limited time I was able to research this subject in terms of building out a new system, appears that folks will take a stream of revenue that has a track record, in particular like a sales and use type of tax, and then they will pledge that to repayment of bonds that then help with the build out of a broadband system. So Rock Falls, Illinois, and I don't know if this is pronounced Leahy or Leahy, City, Utah, are both examples of that. In the Utah example, they were starting from scratch when they decided to build out the broadband system, but did have the benefit of a long track record of collecting. In that instance, they pledged sales and use tax as well as a tax on energy distribution or something of the like. so they're sort of getting around the fact that they don't have any real track record on revenues from broadband. They also avoid, and this is from one of the Colorado deals, a statement from the rating agency report, they avoid the market risk of the system. They avoid the technological risk and the dynamic operating environment of a telecommunication system versus, say just a sales tax revenue or something of the like. So that's one method people have used. Another common method is that, and I'm sure you all are way more familiar with this than me, but you have an electric utility who expands into broadband. There's obviously some good reasons for doing that. Longmont and Fort Collins, Colorado are both examples. And what they did there was that they pledged, they have a general, they have a security structure that includes the general revenues of all activities, electric utility and broadband included. The electric utility is much more stable because it's been around longer than, say, the broadband, and does not have, the same competition dynamics as does the broadband. But then that allows them to have fairly high debt service coverage on their bonds, and the broadband revenues then go to support that. But it's not exclusively the broadband revenues that are, backstopping the bonds. And then finally, and I have to admit, this is the only example I could find which isn't to say that it's not the only one out there. You have a lien just on a broadband system here at home. EC Fiber is a great example, where revenues and fees of the system are what are pledged to repayment of the bonds. I think I'll just go over this generally, but I wanted to include this in here just to give you a sense of what underwriting looks like or would look like, both from a rating agency perspective, if folks chose to have the bonds rated, or an investor would do the very same analysis as would a rating agency. So either way, they're looking at the same metrics, the same sort of global evaluation of the credit. But the top is the Moody's general municipal utility revenue debt criteria. I have a little quote here, usually in a government protected monopoly. That's obviously a different case here. So in some sense, broadband build out looks a little bit more like project finance, which is typically done through a P3, but nevertheless, I think is relevant because project finance has more of the technological and market risks that a broadband type of debt structure would have. Either way, if you examine these, like the ratios look very similar. So there's no magic to how folks look at these types of credit evaluations, but generally they're looking at least on financial strength, annual debt service coverage. You see there that on the municipal utility side, they're looking at 1.25 times to 1 to be in the investment grade range. They're looking at liquidity, so days cash on hand, and then debt to operating revenues, which is a measure of essentially debt to capitalization via another means, because it's oftentimes hard in a municipal system to place an asset value on the utility itself. What is the value of a pipe that's been in the ground 70 years, but also is essential to the service. So that's why they look at debt to operating ratio. So you see there about 7 times for an investment grade rating. They're also looking at things like the quality of the management, which really what they're looking at there is the ability to levy fees such that they can produce rate covenants that have been promised. In some instances, you'll have a debt service reserve requirement, which really serves as liquidity for the payment of debt service until the system can be righted to pay debt service out of cash flows. And then, in the municipal world, they're always sort of looking at the service base or the wealth of the underlying community. I think we think about this differently. Is that like we want broadband to go to the people that need it most because it produces the most economic bang, but they're fairly cut and dry at the rating agencies, and they're really looking at abilities to pay when they look at service area wealth, rightly or wrongly. So that gives you a sense of utility revenue debt. The project finance criteria looks very similar. The ratios are a little bit higher, mostly because project finance typically debt service coverage ratios are going to be built on projections, given the fact that there is construction risk built into the structure of the deal. And so that's why they want to see higher coverage ratios. But I really include this just to give you a sense of the types of things that an investor or rating agency would be looking at, like market position, like technological risk, and things of that nature. So then finally, and then I've just got one more slide after this, give you two sort of case studies with some high level takeaways of two broadband transactions that were done. The Longmont, I mentioned Longmont previously. That's a community in Colorado in Boulder County. It's just north of the city of Boulder, if you've ever been there. They have an S&P underlying rating of A, flat, for their electric and broadband utility. They actually used something called bond insurance, and that's something to keep in mind for the future in Vermont. But the bond insurers, there used to be a pretty robust bond insurance market, but it fell apart after the Great Recession because they got into things really that they shouldn't have been into, and then also had some large exposures to places like Detroit and Puerto Rico. But regardless, the actual bonds were sold at a AA rating, underlying A rating. And then in terms of the actual structure of what they're offering, a net pledge of the combined electric and broadband system. That's something I had mentioned before. This is very common in a revenue bond, that you're going to have a rate covenant. So in each fiscal year, you're going to need to show rates sufficient to meet, in this case, 125 times principal and interest after removing expenses from gross revenues. And those will all be laid out in the resolution or the security structure, the trust indenture of the offering. In this case, they had fairly high, service area at 120% of median household income. Boulder County's household income is actually quite high. The broadband system, even though the revenues weren't exclusively dependent upon this, has a higher take rate than what they were expecting. Days cash on hand, 46 days. That actually seemed low to me, but that's where they were. Fairly low leverage, debt to capitalization ratio of 36%. Because they have that those electric system revenues included in the structure, high debt service coverage ratio of 3.77 times. And then to give you a sense of how much of their revenue is coming from broadband, in this case, 15% of 82 million in revenues. And below there is just a quote from the rating agencies, again, to give you a little flavor of how investors and rating agencies are going to look at broadband. Again, no surprises here, but basically technological and market risk are the things they're kind of focused on, that are unknowns that they are hard for them to get their heads around. Moving over more locally to the most recent EC Fiber transactions is from, in fact, their limited offering memorandum just recently did this. They've got secured by the revenues of the broadband system, and then in terms of the assets themselves, also included in the revenues is any sale, lease, or disposition of any asset in the network that would either be used to pay debt service or used to pay down debt service. They have, unlike Longmont, they do have a fully funded debt service reserve fund. Those are typically debt funded. So there's a carrying cost associated with that debt service reserve fund. In addition to the debt service reserve fund, there's a requirement to have a reserve and contingency fund, and a rate covenant that matches what we saw in Longmont. That 125% rate covenant is extremely common in the revenue bond world. And something that's also common is that you have to meet an additional bonds test on existing debt plus new debt, having net revenues be 125% of existing debt plus new debt projected to be allowed to issue more debt. Fairly significant debt service debt service coverage. In the case of EC Fiber, 1.77 times. And then I was pleased to see debt to capitalization and debt to revenues ratios that are in line with kind of the lower end of the investment grade spectrum. And I believe that service area at 120% of household income, excuse me for that, that was just a carryover from copying and pasting on the other side of the analysis. So I'll erase that in the final version of this for you. And Christine, you can tell me, I do have some recommendations. I don't know if you want me to stop there or continue going.
Michael, could you go back a slide too for a
Yep.
second? And Christine, I didn't mean to interrupt.
No, it's all right. Good.
So when we're talking about these, I'm getting a lot of feedback in what I'm hearing. Are you getting that same feedback? Oh, somebody fixed it. Okay. So Michael, when we say things like the projected take rate or the reserve contingency funds here, things that project outward.
Mm-hmm.
How often, what's the test on that? How does that get monitored?
Yeah, that's a great question. So it's kind of two questions. One is like, I think how you deal with projected systems or systems that are in the process of being built out. And so that's why I was, kind of showing you what the project finance ratios for Moody's look like. So investors, rating agencies are going to look for higher debt service coverage projections on things that are subject to, revenue growth. And the other thing that they're probably going to want to see is that, I think if you're significantly into growth in terms of what you need to meet debt service coverage, that kind of gets you out of the investment grade range pretty quickly on a system like this. It kind of gets you in the speculative high yield world. But what they certainly probably are going to want to see is some sort of, in an ideal world, a third party independent analysis of the projected revenues that can be included in the offering memorandum as a document for investors to review. And so that would have, an industry expert looking at, what take rates are going to look like in correspondence with the build out of the system, what they project revenues to be, and sort of fact checking to the extent that's possible projected revenues. So that's one.
So that's really a pricing response, which I appreciate.
Yep.
I'm trying to process what the experience of a CUD will be, and maybe we should just ask like EC5 or what their experience has been. But I know if you came back to the bond bank and you want to take additional debt, they would look at how you performed on an initial round. But is there a covenant in this arrangement that causes you to have to report your performance every year or something like that? And one of the reasons why I'm asking is there's a lot of unpredictability in these construction markets, both based on the resources for fiber personnel, just plain how long it takes. And I wonder, I would like you to comment on that predictability and how it impacts not how this is set up against some model someplace, but how it impacts the performance under the bond and what happens.
Yeah, and actually, if I could jump in, I have a piggyback question I think ties in with what you're asking, Holly, which is when we talk about the revenue growth, the revenue growth is, as Holly's talking about, is first of all interdependent on getting it built on time, but also, it also depends on where you're going. You can see fast revenue growth in unserved areas, but it's slower in the cable overbuild areas. So, in terms of a time frame, what are they willing to tolerate in terms of a revenue growth period? Is it a 4-year period, a 10-year period, or is it the length of the bond?
Yep.
Or do you have to have partners in the electrical business?
Right. Yeah.
Well, so again, not to be, so I think there's a couple things here. Always trying to break them up into slices that I can answer intelligently. So first part, sort of the policing of the indenture or the resolution, that's going to happen by two means. One, that public disclosure that I mentioned via MSRB EMA. So you have what's called a continuing disclosure agreement, which is that's an SEC document. So that's a very important thing. So you've got to post timely financial and operating reports. And then more often than not, the actual covenant types of reports are going to be certifications that are due to trustee annually or quarterly or whatever the time period is that you agreed to do. And so those are going to be essentially on file for investors to review if they want. Once you've sold the debt, those matter to the extent you want to sell more debt. And they also matter to the extent that we want to sell debt for other broadband systems. So you're building, one way to think about this a little bit is you're building a market here. So if you've got one CUD that's going to either have a default real or technical, that's going to impact everyone else. So that's that part of it. And then to your question about projections, it's always important to make sure that you have the right kind of financial facility for whatever it is you're doing. So this is definitely hard debt. It's not, the capital markets are not real flexible. When you get into, the high yield area, there are investors that can structure things such that you have what we call things like turbo bonds, which are essentially cash flow related bonds, or super sinkers or something like that, that will scoop up any excess revenues of the system and are subject to risk. But those things are priced at a clearing rate. They are very expensive. And from just a financing perspective, if you have a public good like this, I'd say they're probably suboptimal, but they're kind of like, you can get whatever you want to get done. It just matters what price you're going to pay, right? Because this is tax exempt debt. So if you think about it, a 7%, say like a 7% rate on a tax exempt instrument on a tax equivalent basis, that starts to look like an equity return. Starts to be well above 10% in terms of return. That's more associated with what you'd expect equity to receive. So that's kind of one way to think about it. Just to really get down to it, Christine, folks, I think probably are going to want to see revenues. You've basically got about 2 years in which to capitalize interest under the tax exempt rules, and folks are going to see a performing project more or less within that time period. If you're talking about something that's a revenue producing entity, if it's tax increment finance or something like that, that's a little bit different. That's fairly tax supported, and that can be a little bit more backloaded. But in something like this, you kind of want to be up to speed within 3 years or so. For the type of debt we're talking about, for a relatively vanilla fixed rate bond offering.
And what's the likelihood of you mentioned that they're willing to do a bond over a 30-year period. Are they willing to go 40 years?
Higher rated entity like the bond bank, for example, AA+, it doesn't matter because we can't do this under statute anyway. But yeah, we'd have no trouble getting that done. It kind of depends on the rate environment you're in. If you're in a super low rate environment with a long-term bond like that, there's more what they call duration. So basically the change in present value to the bond under a 1 basis point movement. If it's longer, it changes the value more. In this environment, that's probably unlikely, to be perfectly candid.
Thank you.
Michael, you talked a little bit about rating agencies looking at some risk factors of market risk and technological risk.
Yep.
In the broadband world, what would you consider technological risk?
I'm not an expert in broadband, so I have you all would probably be more familiar with me, but just investors read the newspapers just like the rest of the general public. So satellite, I'm guessing, cell phone hotspots, things like that.
Okay.
I would say the technology we're picking is pretty low technology risk. There's two things with that technology risk. One is if you get specialized technology, you're probably gonna have to pay more for the hardware, and which is why I think the PON the PON network's pretty standard in the industry, and that's what the CUDs are using. So I think here our technology risk is probably low, if I've interpreted that correctly. Whereas, for example, as you said, Michael, Starlink is probably a higher risk right now.
Yeah, I think again, big, this is more in the weeds, but whenever you go to investors, just having a good answer for a question like that is what matters the most.
Mhm.
So maybe I'll just share a couple of recommendations for the board to think about. Again, the bond bank is not in this world, and I'm really just talking from my own personal experience and experience with the capital markets, but kind of best practices, and this would be the same if I was talking about broadband or a number of other different infrastructure types, but some things to think about, particularly given what we're kind of thinking about here is developing a market for bonds issued by CUDs. Standardization and best practices that are universal are a good idea. In our world, there's something called an independent registered municipal advisor in IRMA. They have to take licensing exams, and that is an advisor that will work with you when working with the investment bank and the underwriters, and they can help ensure, they can help lend their expertise at the beginning to develop a plan of finance that is appropriate given the conditions and requirements of the system, as well as making sure that the rate offered by the underwriter is fair and that the compensation received by the underwriter is fair. Under Dodd-Frank, and IRMA is a fiduciary of their client. So as opposed to the underwriter, who is in a relationship with both the borrower as well as the investor. So that can be a good, I think that's a really good idea to sort of develop the preconditions for when CUDs might want to enter the capital markets. Similarly, municipal bond counsels, a very specialized types of legal opinion that's offered on they'll give both an opinion as to the validity of the bond, which is a little more straightforward, but also a tax opinion, and that can get super complicated. And so, getting them on board to develop the kind of standardized resolutions that we want to use for CUDs would also be a good idea as well. And that can, if you're creating a new resolution using a new bond counsel every time you're doing a new CUD offering, that can be, bond counsel is very expensive. That can be a lot of duplicative costs. So that's, I think, a good idea as well. And then there might be some other shared service contract, shared services or pre-qualified pool that you might want to arrange. Bond trustee, paying agent. Those are the ones that actually are the kind of fiduciary of the funds in the security structure. Or say an independent third-party feasibility provider, so that investors, whether it's no matter what the CUD is they're looking at, they have kind of a more standard set of documents that they're reviewing. And then, as I mentioned before, there's this new kind of wrinkle due to the infrastructure bill where private activity bonds subject to volume cap can be used when you have a private entity participating in the project, either as an operator or a guarantor of the debt or some other type of relationship. You can't have private entities participate in tax-exempt bond offerings subject to a qualified management agreement, but that qualified management agreement generally does not allow the private entity to participate sort of in the upside of the system in any way. So for example, the revenues would need to be based on kind of a per unit fee or as a percentage of gross, but not net revenues. But if you don't meet those, we could still get volume cap. We've got a decent amount of volume cap in the state, but under the legislation, here's these three next bullet points are some of the requirements in order to use the private activity bonds. I think all of which we would probably meet. But the key is we got to identify, we got to slice out volume cap for the CUD and make sure it gets allocated to them if they need it. So those are just some general recommendations, and then if there's any additional questions.
Yeah, I have one more additional question that kind of relates to what you're talking about before. It sounds like it's, it sounds like the transaction costs are fairly high, and your recommendation is that we try to combine as many of the CUDs as possible. Is that what I'm hearing, or is that?
No, well, I mean, maybe. I think, well, I think two things. One, I'm gonna stop sharing screen if that's okay with everybody, just so I can see people's faces. Um, I think that once you know sort of what the structure of the type of debt they need is, then you can start thinking about the best way to structure it. So maybe it's a pooled loan structure if we think enough of them are going to need capital at the same time, or if you can arrange interim financing such that they can all seek long-term financing at the same time. Pooled structure might work, but I guess where I was going is that to the extent that you have like a resolution, which is essentially the trust indenture for a governmental entity that is the same in all cases, then you have the board has counsel on involved, and then you hand it to the next CUD and say, okay, let's customize this for your specific circumstance. But basically, we know what the document is, rather than to create it wholly new, from the and that can reduce the amount of costs of bond counsel substantially. Does that make sense, Christine?
Yep, makes a lot of sense. And Patty, I was going to recommend that maybe since this is really directed to help the CUDs, maybe if the CUDs have any questions, we can take them as well. Is that, you willing to do that?
We can take a 5 to 10 minute Q&A at the end of the presentation, but let's get to board members of VCBB first.
Okay.
One of the things that I was thinking about when you were talking, Michael and Christine, about the bond issuance and making best use of bond counsel and the IRMA advisor, to me it kind of struck a chord of possibly VCUDA being in charge of that, because the CUDs are in charge of their own indebtedness. VCB is helping them out with some grant funds, but I don't see VCBB personally, this is not the VCB's opinion, but I personally don't see us getting into managing their debt issuance. But certainly the VCUDA group is an association, but that should ring to their ears about getting some, legal counsel and sharing it among the group.
Yeah, no opinion on my side, just a general recommendation. I think the thing I'm always mindful of in cases where you do have so much public money and public support involved is that you don't want to burn up that support in interest payments to outside investors. And so how do you sort of reduce those interest payments in a way that's practical? That's the only reason, I think you'd want kind of a global solution.
Anybody else on the board have questions, comments? Laura, you're muted?
Yeah.
You're up.
Yeah. Can you just kind of walk me through what that would look like if you grouped a couple of CUDs together? I'm not sure that I'm not sure I understand like how we would do that.
You mean in like one debt offering?
Yeah.
Yeah, you could do it a couple different ways. There's what the bond bank does, which is that we've got a parity, like all of our loans are support all of our bonds. So it's a parity structure whereby, bondholders are supported by the diversity of the portfolio, right? But in order for that pooled structure to really achieve scale and get a decent rating, you've got to have a lot of entities, and you're just never going to have enough entities with the number of CUDs we have in the state. But another method might be that you have so they could look at something that's on parity, but to me that seems complicated. But you could potentially do something just where everyone is joint and separate in terms of their payment within a pooled loan structure, and they have their pro rata short portion of the offering, but they benefit from the economies of scale of a joint offering. But then in that case, you'd probably need some sort of global entity to actually be the name on the debt. There's a couple ways, you could kind of crack that. nut. But that's a good, that's a perfect example of where the independent registered municipal advisor could be very helpful in thinking through, uh, the most appropriate way to raise capital that's the most efficient.
Okay.
I'm also
And-
not saying that's necessary by any means. Certainly each CUD, if they're large enough, could go and issue under their government issuers. They can sort of do what they need to do.
Yeah, and what is large enough?
Yeah, I was saying before, probably, but this is for capital markets. So if they went to a private bank, that could be $100,000. It could be very small. But in terms of accessing the municipal bond market, I think you'd want to be at least $8 to $10 million, if not more.
Okay. And so your recommendation is to retain a municipal bond advisor for the CUDs.
Yes.
And Madam Chair, I believe I heard you say your preference is for that to happen at VCUDA and not VCBB? Or did I misunderstand that?
Well, not necessarily the IRMA, the independent registered municipal advisor, but I'm thinking the bond issuance should be not through VCBB.
I gotcha. Okay, I gotcha.
But if
So,
yeah, go ahead.
So I'm interested in moving on that, I think, as quickly as possible, that advisor role, to, first of all, because it may take us a while to find someone, and second of all, because, any time that we can give to our CUDs on this. So just put that out there. Thank you. I think that's the end of my questions. And
certainly, I would like to hear from the CUDs to see if they're even interested in that, or if they're thinking they want to go solo on this, despite what we've heard today. Holly?
Patty, you have more experience in this than I do. You're pretty clear that you don't think that an aggregated offering should happen through VCBB. I don't even know if we're authorized to do it, but what's your opinion based on?
I could see an aggregated offering going to the bond market outside of VCBB. I just don't see our role in this is directly tied to issuing the debt. We're the grantee of grant dollars, and our focus is on that. I just don't see us getting into advising on the debt issuance.
Would you want council to look at that authorization, or are you just very clear on that?
This is what Patty Richards is saying. I'm not representing the VCBB in its entirety. So absolutely, if we want to have Stan take a look at that and give some thoughts, I very much appreciate his opinion.
But is there anything in statute that would indicate that VCBB could issue debt like that? I'm with you, Patty. This would be a curveball to me if that was an interpretation.
I'm only asking, Brian, because there's language about collaborating or facilitating. I don't think it goes to the level of issuing, but I didn't know whether we wanted to consider whether we can make that case or not. It certainly is a continuation of the work that we're doing in terms of supporting financially. But so I'm just curious. I'm curious.
I mean, I would look at it, I'm wearing my utility general manager hat right now, as a group, an aggregation of a group of utilities or of a specific utility. I have the ability to raise rates. So the bond market's going to look at us as VCBB and say, if things go south, what capacity do you have to assure the bondholders are going to be repaid? We don't have that capability. We can't issue taxes. We can't demand a legislature give us funds to support the CUDs. We don't have any of that strength behind us.
I'm listening carefully to Michael, though, in his separate but equal comment about how the obligations might be individual to the CUDs, and an overarching entity might just serve as the aggregator. But I totally follow your line of reasoning. I'm just looking for ways we might help.
Agreed. Brian, did you have any other thoughts here?
No, I'm kind of where you are, Patty. It would seem a departure from our charter if we were to take that step, but I'd be curious to get if so. Let's just, for argument's sake, assume we don't do that. I'd just be curious in any of the CUD feedback if we were to have that position.
Yeah. Okay. Let's any folks from this VCBB staff want to chime in before we go to the CUDs, and then we'll open it up to CUDs. Rob or Stan, Melissa?
I guess I can just say is I do think that there is a need for the bond counsel or the municipal market advisor as a shared service for the CUDs. That's something that we've talked a little bit about on as a staff as a possible next step that would complement the broadband project developer position when that is hired.
Okay, thank you, Rob. All right, let's open it up to the CUDs, VCUDA and CUDs to give input. I think, Rob, I can't see all the hands here.
Sure, it looks like the first hand is FX from EC Fiber, the only CUD that has a bonds right now. Go ahead,
Okay.
FX.
Yeah, good afternoon, everybody. Thank you. So, so number one, the bond counsel for EC Fiber very conveniently is also of counsel to VCUDA. So we've kind of already got that lined up. And we've issued, I guess, 7 different sets of bonds. So we've been through the development of all of the various resolutions that the board has to pass a number of times, and I believe that it's become pretty routine for us. So to the extent that the other CUDs follow our model, a lot of that work is already done. And we're already set up at VCUDA to ask our attorneys to take on that role. I will say that as a prospective investor and as somebody who's participated in pulling together all of the background work that goes into those bonds, my guess is that each set of bonds will be issued individually to each CUD, and it becomes massively complicated to think about a 2 or 3 or 8 or 9 participant bond shared in by the CUDs. I think that on the face of it offers a level of complexity that that we wouldn't want to touch, given the way things are set up now. If the bond bank wanted to get in the business of revenue bonds for this sort of thing, it might be a different story, but I think it would have to happen at that level.
Great, thank you, FX. Next up, we have Stephen Friedman.
Thank you. I'm on the board of Lamoille FiberNet. I agree with Michael's recommendations to get the MA service and the bond counsel service at a higher level, that can serve all of the CUDs. There could be at some point some conflicts between CUDs, but I think that's less likely than the benefit of having a common structure that's developed and a common marketplace developed. So I think that's very sound advice. And I actually am a municipal advisor, but in a different part of the world. I practice in economic development in my day job, but and of course I would be not able to do this even if I were qualified because of the conflict of interest. But I do know a little bit about the the realm, and I think Michael's advice is very sound.
Thank you.
Stephen, this is Patty Richards. Would you support VCUDA obtaining the IRMA and Bond Market Council?
I think so. I think that's more of a question for my chairman, Jen Campbell, who's deeply involved with VCUDA. But VCUDA has been doing, from my perspective as just one of the board members, seems to be doing a very good job of common services for the CUDs, fiber buy, other equipment buy, and so on. And it seems to be a logical place for this to rest, and they seem to be developing the infrastructure to be able to accomplish these things.
Thank you.
Okay. Next up, we have Krista from Northwest, followed by Sean from Northwest. Krista from NEK and Sean from Northwest. Sorry. Go ahead, Krista.
It's okay. Having an identity crisis there. So I guess just to answer a couple of the questions that were posed and then to pose my own, we're definitely only interested in bonding independently. Agree with the comments of the overcomplication of multiple CUDs trying to pull that together. We've all got different business models and some have different structures. So, but I do definitely agree with the recommendation for IRMA and Bond Council. I think it makes sense for VCUDA to do Bond Council, and I think it could go either way in terms of the IRMA, the municipal advisor. Two of the questions that I have is I'm not actually clear from the presentation what role Vermont Bond Bank is proposing that it might play. And I'm also in a more finite or a more detailed question, curious about when you refer to develop a plan of finance and rating strategy for all CUDs. I understand what a rating is and I understand the pieces, but I'm curious if you could speak to that rating strategy piece a little bit more.
Sure. So first up on the bond bank, we were invited, to this conversation. So we don't propose that we have any role for broadband at this time. The obstacle we face is that 100% of our existing portfolio and our existing structure has monopolistic power or taxing authority. So, we would face the obstacle of potentially, increasing the rate that we would offer to, our traditional customers, borrowers, if you will, by including something like this, which does not mean that we're not supportive and it's not a critical infrastructure for the state, because obviously, to the extent towns have good broadband, they become better borrowers because they have more opportunities for growth. So just say that at the forefront. And it also does not preclude something down the line once this sector becomes more mature and we could somehow segregate that risk. But that's kind of for another day, I think. Regarding rating agency presentations, before you talk to them, you just want to have an understanding as to the financial metrics that you need to meet and what your system is doing and what you anticipate it to be doing. So basically developing a checklist or really benchmarks by which you can compare yourself to see if you're market ready. And it's appropriate for you then to talk to the rating agencies is where I was going with that. I also think I didn't spend a lot of time on it because it's fairly in the weeds, but it was interesting to me in reviewing some of these transactions that assured guarantee, a bond insurer, seemed to be present in a lot of cases. And I think that's interesting because what bond insurance allows you to do is to sort of homogenize the credit from the view of the investors, and then kind of makes it an easier sell. So that might be something, again, if you had registered municipal advisor on hand. They could have the conversation with Assured as to what kind of financial metrics they'd want to see, what the cost of bond insurance would be, and then that could help sort of pave the way for CUD bond issuances down the road if you could insure them at a AA flat rating from Assured. Hopefully that answers your question, but I guess benchmarking is kind of the thing you want to be ready for before you talk to the rating agencies, so you know what you're getting into.
The next question is from Val Davis in Lamoille.
Thank you, Rob. I'm interested in the actual logistics of this. If VCUDA or a couple of CUDs were to decide that this is the route that they wanted to go, but what is the time frame before we would know that there were revenues there that we could build into our model? Are you able to hear me?
Yeah, we can hear you.
Okay.
Val, are you asking how long it would take to get a revenue bond?
Yeah,
From the
yes.
state?
What's the process? What's the timeline? If we started the process now, would we know for sure that in 12 months we'd know where we were?
Well, I think one thing to keep in mind, I didn't put it on here, but probably should have, just from the market perspective, they want to see an operating track record with real assets in the ground. So you at least want 3 years probably of audited financial statements at a minimum, and you want to have cash flows that are associated with the enterprise prior to even sort of entertaining the idea of a revenue bond. If depending on what rate you want to get, certainly you could go to market sooner, just a different analysis.
Thank you.
Yeah, you could take FX Flynn's question next. I'll ask my question at the end because I have a question more for the board.
Yeah. First, is there, since FX, I know you already had your question, I just want to see if there's anybody else first. If not, I don't see any other hands, so, at least I don't think I do. Hold on, sorry. I think it's just you, FX. I guess go for it.
Yeah, not a question, really, a comment. So the the investment bank that we've been working with to place our bonds, Jim Anderson has been talking informally and educationally with a number of the CUDs. And his thinking is that given the success that EC Fiber has had and given the state's support of the CUD model, and given the fact that the grant funding is going to support getting a lot of assets in the ground, it may be possible to think about floating municipal revenue bonds before the 3 years of audited financials are actually in place. That it might be as quick as a year, because they would be able to turn around and say, look, this is the same model as EC Fiber. They've already got this many millions of assets in the ground. This is a good deal, and so they're very interested in offering the CDs advice and counsel in this way, and I would encourage everyone to take advantage of that.
Okay, so I'm really want to make sure I've got the will of the board. From what I'm hearing here, what we're recommending is that the VCUDA go obtain the municipal bond council, or what I would suggest is that, and I want to make sure the board's okay with this, that the VCUDA comes back with a grant request for that specific position to present to the board. Is that really, am I reading the board correctly with that statement?
I think that's one way to slice it, Christine, is that if VCUDA feels like they need financing to pursue that, rather than the CUDs rolling that as a project cost into, basically their overall project cost. It's one way to pursue it. I don't think it's the only way.
Yeah.
This is Rob. I do think there's a question that I don't know if the board has ever settled on of whether we can grant to Vacuda directly. That could come into play here. Something to think about. Will also does have a comment, so maybe that would be responding to that.
Yeah, I mean, I was essentially going to say the same thing. In the past, the board has stated that although a Vacuda does represent a partnership between CUDs, it doesn't represent a provider. And as such, the board has been hesitant to providing grants to the association. However, we are able to essentially charge CUDs to use services, by getting grants from the VCBB in order to use our services. This may be something that could work for this, as CUDs could use the service as needed, and provide payments based on that. But we would likely need, although FX is right that we have some infrastructure in place to provide this already, we would likely need to finance this either through the VCBB or through a mechanism by which the CUDs pay into the association for use of the services.
Mm-hmm. Yeah, and I see, I'm looking at Act 71 in section 8087, centralized resources for communication union districts. We have a mechanism with which to grant funds, in my opinion, based on that section. But to me, this really boils down to how do CUDs want to slice and dice this? If they want to do it through Vacuda, if they want to do it independently, it's this is their ship to run, so to speak, in terms of the structure of how to put it together.
If I may, just briefly, as no one's talking, I think that we can definitely formulate and figure out the best way to go about this. We do have a Vacuda meeting next Monday, and I assume that this will be a subject. But I think that we can pretty quickly figure out where our 9-member districts stand and decide on a path forward. It looks like there's multiple routes by which the association can facilitate access to these resources. So I think that either through a grant proposal by us or another route, we can decide on that on Monday, and I can communicate that to the board and at least figure out where the association stands in this matter.
That's good. Okay. Is there anything else that we would like to tee up here on this subject of bond bank, the bond bank and Michael's presentation?
I did just want to let everybody at home know that the presentation is posted on the VCBB page with the agenda and the minutes and the materials. So we added that this morning, as is the letter we'll be talking about next.
Excellent. Michael, thank you very much. I thought your presentation was very educational. It was very well received. Thank you.
Yeah, thanks so much. And don't hesitate for both Vacuda as well as other board members to reach out. Love talking about this stuff. And we're also very happy to share, we've done RFPs for underwriters, for municipal advisors. We're happy to share our base documents and talk through the issues that need to be considered. So don't hesitate to reach out. Thank you so much.
Great, thank you. Okay, now we're going to move along to the material default discussion. Christine, would you like to tee this up?
Sure. Yeah, we presented some language around material default at the last meeting. The board asked to go back and do some work and make some changes. Stan has taken that on, so Stan, I'll turn this over to you.
Okay, thank you. I last week circulated to Vacuda to get input from the various CUDs, a list of questions based on the material default failure to comply analysis and paper that we put together last meeting. I asked for comments by Friday, but people are busy. I've only gotten one so far, so hopefully some more will come in the next few days. But based on the one comment received, the one of the questions that we proposed was a 30-day correction period. The commenter recommended that be longer than 30 days. And one of the other points that I made was for bond covenant, breach of bond covenants and financial agreements, should that be coupled with other factors to be considered a material breach? And the commenter agreed that yes, there should be other factors. It should not just be a breach of a financial agreement. I said in conjunction with accelerating debt or bondholders taking legal action, something along those lines.
Okay, Holly.
It strikes me that this is a little bit like asking the prisoners how long they should be incarcerated. I'm wondering whether we should instead be looking at what the default procedures are in major construction grants or other municipal. I was overwhelmed and in fact daunted by the number of questions that were posed in your document. So I'm not entirely surprised that along with asking how long you want to be incarcerated, the questions just might have been overwhelming. So rather than wait for additional responses, which might be forthcoming, we might look at other comparable examples so that we have some basis on which to say, we looked at this and this is where we came out. I would be also, along with the prisoners, thinking that 30 days is not enough time, or it's material what the kind of default is to have a remedial period. Some things can't be done in 30 days, although I've never seen a default that wasn't preceded by a lot of conversation before you even got to default.
Yeah, exactly. Yeah, I'm happy to take a look at, say, construction grant default provisions and see if we can learn anything there and come back to the board at the next meeting.
And I gotta presume, Stan and Christine, that there's something at the state level to aid us, because it's, we shouldn't have to invent the wheel here. Whether it's construction grant efforts, but the state's got to have something in terms of what materiality means, is my guess.
Yeah, actually, I think that's a good suggestion. I think we will follow up with that and look at some other examples. I would also say, too, I'd like to add that, there's a difference between taking corrective action and putting together a corrective action plan. So maybe we do the timing in such that we need a corrective action plan in X amount of time. But, and that correction plan will have a timeline related to it that we'll agree to. So there may be some misinterpretation of that, but at the same time, I think the suggestion to look at some other examples, I'm sure we'll have the same, some examples around how you take corrective action in the event of material default as well. So I think I certainly appreciate that suggestion.
I would just have a follow along comment for you, Christine. You're a person of action, and so you do think in that kind of process way, and I appreciate that. But I think what we're looking for here is to establish what materiality means on a legal basis, and identify specifically those triggers. You can implement in a way that has a lot of buildup to what would be materiality, but that would be what materiality means.
Oh yeah, yep, I'm with you. So there's so where you're going is that there's really the material default becomes a switch once you cross that line. But part of that, I guess, what I'm thinking about is the process up to that. Yep, I agree.
Yeah.
Okay, so there'll be more to come on materiality.
Yes.
Okay. Anything else before we move on? Hearing nothing, let's move to the fifth item, letter of commitment, discussion and motion.
Yep, I'll turn that over to Stan as well.
Okay.
Stan, if you want to share your screen, you should be able to with the memo.
Oh.
And that is posted on the VCBB website now too.
Was this not included in the board book?
This was not, this came out today. Yeah, I circulated it today. Can everyone see that? Did I share?
We were going to just do it as a oral presentation, but thought it would be good for the people at home and everybody to have something to see. So that's why it was a late edition.
Yeah, you'll want to zoom in on that, Stan.
Okay.
Yeah, just adjust your view. Yep. There you go.
And Stan, if you don't mind, and Patty, sorry for just jumping in, but could you again remind us of the context of why this is critical?
Yeah. You want me to take that, Stan?
Sure.
Yeah. So this really ties to the pre-purchasing of materials, long lead time materials. You know, this is a follow-on to the fiber purchase. There are a number of other bill of material items that are also of long lead time, right down to specific bolts that go with the system. So we'd like to be able to provide a process for the CUDs to be able to pre-purchase those materials prior to construction. Does that answer your question, Holly?
So we had some conversations with the Consultants Guidehouse last week, and based on the information we learned there and concerns that were raised last time we discussed this at the board level, we came up with these points that the letters be letters of intent rather than letters of commitment or other memorandum of understanding. So that they're not viewed as creating a legal obligation, and that if the board intends to issue such letters of intent to the CUDs, that if it then subsequently decided to deny a grant, that that there be a justification, a thorough justification of that denial in the board's decision making to protect it from the risks of possible litigation. And the letters would only be issued after eligibility screening and an invitation for a full proposal. So we would have information from the CUD. And that the letter of intent limit the amount of funds at least to the amount allocated to this CUD for the current year, possibly for a percentage of it, say 75% or 80%, which is what's done in some other industries. To guide.
Okay, questions or comments?
Holly has her hand up.
Go ahead, Holly.
Okay, I've carefully looked at the example of the individual consumer needing one of these letters in order to get a rent agreement and get public assistance for rent. I find that example completely inapplicable here. And I think that it's really wild to equate the kind of money that you're talking about and the chicken and the egg problem that the renter has in that scenario with what we're talking about here. This is like pre-authorizing the entire project from my point of view. So I'm very definitely not in favor of it. But should the board decide that it likes this idea, I would urge us to not only require a screening, but it's putting the burden on the board to be definitive enough about why it didn't give the grant. So it is raising the level of obligation on the board to be careful about how and why it does not allow the grant. But I think we should also, in addition to the screening that you mentioned as a precondition, identify exactly what it is being used for. It's one thing to say, well, there's stuff that has a long lead time. I think we should have a verification of what that stuff is, some basis for the proof before we get into this pre-approval, having people half pregnant with their grants. Thanks.
Thank you, Holly. Christine?
Yeah, I'm kind of going to follow along with what Holly said in kind of a different way. I think that, what we're talking about here is specifically related to specific part numbers on the bill of material. So I don't see this as issuing, significant amounts of money across the board. It really is to help the CUDs get certain material, and certainly VCUDA would play a role in that.
It's really a confidence building measure that's going to help them be able to access and get conversations going with providers. But I don't think there's any problem with being very specific, of not having it automatically issued upon acceptance into the eligibility, but issue when there is a request for a long lead time item.
Rob, are you saying they have a lack of confidence?
I'm saying that big suppliers that have many people to choose from like to see that there is a likelihood that grant funding is coming, and that process has started before even having conversations sometimes, since demand is so high. Kind of opening the door.
Laura and Brian, any thoughts or comments?
Nothing from me.
Yeah, I'm just wondering about, I'm wondering about what our obligation is in issuing these letters of intent. Once they're issued, what is our obligation?
Legally, they don't create a legal obligation. However, the board says it intends to issue a grant. Then if it doesn't later on, there's risk there.
Yeah, the way it was explained to us by Guidehouse was, it follows along the line of negotiating in good faith. If the board, and I don't see any problem, I don't see any remote possibility of this happening, but if the board should arbitrarily turn down a grant with no reason, just because, then we haven't negotiated in good faith. But if we reject a grant because for the reasons identified in the RFP, then we're acting in good faith. So it's just one step above, saying we're going to do this. It's saying that our intent is to do this, but it doesn't have the obligation other than that we negotiate in good faith.
Can I ask you, Christine, at the point that the grant applications are coming to us, do they have specific bolt and part numbers in them so that you can actually identify where this urgency exists?
They not in the overall grant application. That's really why this is needed, because we're not going to go through an entire bill of materials in a grant application. But the issue is, for example, let's just say, use a bolt as an example. If a bolt, one part number, like a bolt, is going to hold up construction for a year, we certainly would like to, as done in the fiber purchase, we certainly don't want that to happen.
I'm going to suggest that we all think about, so Stan, I have not read the letter until just now, and I would like to have some time to process both what you have up on the screen now and the next page that I have not read yet.
Okay.
For me, it's too early to take action on this, and I would like to table it till the next time. I see that there are some hands up coming from the participant list.
Oh, I have a question too, Patty.
And rather than take comment right now, we can certainly, in the public comment period, open it up to anybody who wants to take comment. But we're not going to take, I would like not to take action on this if the board is in agreement with that.
Yeah, Laura had a question.
And Laura, your hand is up.
Yeah, I'm in agreement not to take action, although I would like us to try and find a way to do this. I am not concerned. So, back to my other question, Stan. So if a letter such as this, I mean, this may be, Patty or Brian may have more information on this. If a letter such as this allows materials to be, advanced on credit, and then we don't provide the grant, who's on the hook? Why are you shaking your head, Holly? Is that your question too, or do you already know the answer?
No, I don't know the answer,
Okay.
although for sure the CUD is on the hook. For me, it's just, I'm looking at the administration of promises made, relied on by third parties, perhaps purchase orders being placed without grants being authorized. And I understand that there are these issues. I wish we could aggregate the needs, identify what the long pole in the tent is, and do something more akin to what we did with fiber. This is opening up kind of a skirt the grant process, get your stuff in order, and then apply. I know that's not technically what we're doing because we're doing a screening process, but I don't hear that we have an administrative process in place to manage this.
Good point.
Yeah, I think that's fair.
Yeah, and from my world of the electric sector, a letter of intent is written with several caveats, explicit right from the get-go, non-binding letter of intent. Let's say I'm going to participate and develop a wind project. My utility XYZ is interested in participating in a purchase power agreement. This is a letter of intent only, non-binding, no commitment, several layers of exclusions to insulate from risk. If the CUDs need something stronger than that, I'd be worried, because we can't put VCBB on the hook and, like you said, basically prematurely or early on give a commitment, and then if we don't give them the funds, we're somehow liable and on the hook.
Yeah, we thoroughly reviewed that with Guidehouse. It kind of makes you wonder. We had the same question. We met with Guidehouse. It's like, well, if we're not making any binding commitment, is this worth the paper it's written on? Well, apparently it is worth something. It's just, but it's definitely not binding.
Mm-hmm. Holly?
So what you described, Patty, is not binding, and everybody knows it in that commercial environment. But it's still used as encouragement, I guess. I'm wondering whether we could meet this need by saying that issuing generalized letters that said something like, we recognize that, insert the name as a CUD, and that the grant award allocation we have on file at the VCBB is up to X amount of dollars. and that we anticipate that grants will be awarded to CUDs upon completion of a grant process. We don't tag it to any specific need. We don't tag it to any, and then the CUD is going out totally at its own risk and its own expense if it wants to get in line for a particular something or other. But we have verified or kind of validated their claim that they have an allocated amount of money that is in fact being available to them when they reach the hurdle. That way we could do it across the board to everybody. It's not based on what widget you happen to be worried about. And it's not something that we have to worry about defending.
That was our initial intent with this. That was the idea behind it. It was just going to be after we've decided they're eligible, so that they jump through another hoop. But we could.
You don't even have to be. You don't need to even be eligible, except to the fact that the VCBB recognizes that you're a CUD and that we have set aside a grant, construction grant allocation with your name on it. That's the.
I like that, Holly. Laura and Brian, do you have a reaction?
I also like that. If it's enough.
Brian?
Nope, I'm good.
Okay, so we can close on this item. We'll come back with something to that effect.
Okay, and it's a good point that Laura just said, if that is enough. If that does enough for the CUDs. If it doesn't do anything, then we're back to the drawing board.
Well, I think the next step is, if that's not enough, we'll set up an administrative process and recommend that to the board. But I think it's fair, you know, what I hear from the board, what I think is absolutely fair is if we are going to get specific, we ought to have an administrative process that identify that where the needs are justified specifically.
Christine, it might be helpful rather than somebody just coming forward and say, hey, it's not enough. It might be helpful if Stan drafted something that would be an example of what we've discussed, take it to a vendor with a long lead time item, and if they reject it, then it's not enough.
Yep. Okay.
Yeah, but believe Vacuda is looking into some of those issues right now with the purchase they're trying to make of whether it would be enough or not. Maybe Will may be able to speak to that during his talk time.
Okay. Okay, anything else on the letter of commitment? All right, we are right on track for schedule. Let's do staff updates. Christine?
Okay, from a legislative update, we testified on 2 items last week. We testified on the House Energy asked us to come in and talk about what the needs were. You know, that was pretty straightforward. I presented the models showing them, you know, what we're trying to get to a 60% equity level so we can go to the bond market and places like that. And so I think, you know, we're going to continue to defend our desire for $345 million over a 3-year period, but I don't see it. I don't see, you know, and in our discussion with the administrations, there doesn't appear to be much risk at this point for us. There's some other telecommunication proposals that are at higher risk, put it that way. So we testified at the Cow bill. You know, I think that was, you know, the Cow bill was.
What's the Cow bill?
The Cow bill is the bill about housekeeping for the CUDs, and they, you know, I actually think that discussion. I personally think that bill's going to die because it's just trying to, you know, it's a bill out of frustration, I think. So I don't think there's much risk there, and there was some risk in the bill that, you know, talked about going consumer fraud, but that was pretty much shut down, I think, by legal. And then The other piece of legislative action is, accompanying to our discussion for our need for revenue. This whole, we've some, I just want to completely stay out of the discussion on the cell tower issue, and I don't know, Laura, I'll turn to you, but it doesn't appear to me that we're on any risk from that either as well.
Yeah, I don't think that that's a discussion that VCBB should wade into.
Yeah, we've stayed out of it.
And I don't think you're in danger of getting dragged into it. And I think I would say stay out of it.
So did I miss anything, Rob or Stan?
Do you want to touch base on the Act 71 changes?
Oh yeah, we submitted the Act 70. We asked those Act 71 changes we submitted that they board approved to Senator Cummings, and she's going to attach it to a broader tax bill, which looks like it's moving forward.
So the one thing I would say with that, if I might, is just, I'm not sure that tax bill will probably go to Ways and Means if it's the miscellaneous tax bill that's being debated right now in Senate Finance. So I think I would just stay in touch with Chair Briglin and House Energy and Technology about anything that may be happening there.
Okay.
It probably will not go to House Energy, considering the breadth of pieces that are in there. So we'll just need to keep looking at it and making sure it's still okay.
Okay. Helpful advice. Rob, you want to touch on the grant programs?
In terms of the grant programs, the big thing is we're starting to investigate a grant management system that's a little bit more robust, let's say, than the system we've been using with SharePoint. The SharePoint system was able to get set up in a hurry, but this is going to be a program that's ongoing for years, so it may be worth the investment of a system designed for grant management, not just for storing files. That's one thing that Alyssa's starting to work on. Alyssa, do you want to speak about some of the other GIS stuff in terms of some of the maps that are being pushed out?
Yeah, so our work with Stone Environmental, they're helping to upload various layers of data. We have over 5 layers of data in our GIS atlas now that we're starting to take a closer look at and decide what the most relevant series of maps that we want to produce from that to share publicly is. And then after that, the next steps will be to start developing some templates and dashboards to be able to use with some of the individual CUDs. And we anticipate in March that Stone will come and present some of that to share what that is all looking like.
We're also finalizing, we're in the midst of contract negotiations and hopefully close to finalizing an agreement for the fiber optic engineering support. The RFP on the legal support for negotiations just closed on Friday, and we have a few applicants. I think we'll probably discuss those more in an executive session to get board feedback on those, or a different approach that we're considering. The other RFP closes the end of this week or the end of next week for the regulatory assistance. What else? End of this week. Great. Thank you, Stan. We reposted again the broadband project developer position. We've been struggling with finding the best candidate for that, and are starting to take a step back to figure out if there's a way to focus in on the skills and maybe meet some of those needs via contracting. But we're hopeful that we'll be getting some new applicants in, or even going to take a step back and look at our team holistically and to figure out what the gaps are. So we're moving forward on that. Other than that, we continue to provide a lot of technical assistance to the various CUDs. we're especially engaging more with Southern Vermont right now. We found out on Friday they did not receive the NTIA grant that they were hopeful to receive that would have built out their entire county.
So I have a question on that.
Sure.
So I think we'd had a previous discussion. Is that okay, Patty? Yeah. I think we'd had a previous discussion about some of our smaller CUDs that may be having some challenges and whether or not there were funds available or assistance from staff available to come in and help maybe facilitate new processes or new partnerships or really, I'm looking for you know, if we're struggling mightily, how do we not let that ball drop? At least in the interim I would like to see us stepping in at least to say, okay, here is something solid. You know, an entity, VCBB is interested in seeing if there is our additional local, you know, parties that are interested in coming to the table on this and how we can support. So, and I'd like us to be kind of proactive as opposed to reactive in that. And so, you know, I would love to hear just a little bit more, either from staff or the board, if that is a shared goal or, you know, maybe what's going on.
It's certainly a shared goal. We were engaging even before this announcement to figure out the resources that they need to figure out to start evaluating potential backup plans, making connections, assisting with RFP processes, and that goes for both Southern Vermont and Otter Creek.
Yeah, and we're
both
also,
of these CUDs also have a substantial amount. I might have their entire pre-construction still available and capacity, and it's that they. Oops.
yeah, we're, yeah,
Sorry,
we're,
lost you for a second there. So, so they're looking into the best uses for that of potentially hiring up or doing an RFP process. There's a lot going on, but yeah, this still was a surprise on Friday because most of the murmurs we had heard were thinking this was looking pretty good.
yeah, we're also digging into, you know, we just got the numbers. We're going to look deeply into the financials and the numbers. You know, we'll provide that help. We are doing that with other CUDs as well, taking a look at their numbers and see what looks good. So yes, we are following up on that, Laura. That is our plan.
It's not lost on me that the broadband developer position is exactly the position that would be helpful here. So I appreciate thinking about contracting. And again, given the amount of dollars, given the interest, and given kind of where we are at policy-wise, both at the state and national level, you know, I really would like to make sure that we don't have a vacuum opening up there.
Agreed.
Excellent points, Laura.
I think that's everything I have at this point.
All right. Anything else on staff updates, Christine?
No, that's it.
Okay. All right. That moves us to VCUDA update. Will, he's still available.
Thank you. I am, Patty, and thank you for having me on. I have a number of issues to discuss, and I think my strategy today will be working backwards through the notes and issues that we dealt with today. The first being Southern Vermont CUD. Of course, it was pretty disappointing on our end to hear about not just that Southern Vermont CUD did not receive an NTIA grant, but that there were no NTIA grants from that pool coming to the state of Vermont. So this is not a good thing for us, and it's lucky that we have you know, the kind of funding in place already, so that it's lucky that you know, only one CUD really had their strategy built upon this grant, I guess is what I'm trying to say. However, with help from the VCBB, I also plan on supporting Southern Vermont as they develop a strategy going forward. I have contacted the leadership down there and have an idea of at least how they plan to get a new strategy underway. And we'll be participating with them with that. That process is starting as soon as today, and it may potentially play into town meeting day. So there's there's still a lot of hope there, and we'll be working down there to figure out what the solution is. As for Otter Creek CUD, they're making.
Well, before we leave Southern Vermont, do we have any
Please.
idea, any color or framing as to why they did not get the NTIA grant?
I would hesitate to make anything other than speculation.
Okay.
The projects that were funded do seem focused on community broadband. They are perhaps broader in scope. For example, most of the projects were covering entire regions or counties of western states and territories. But I really cannot speculate. I know that there was a lot of effort put into that grant and other NTIA applications here in Vermont, not necessarily by CUDs. It is that is an agency known for a pretty arcane process when it comes to deciding where the money will go, and there's no recourse either to go back on the decision either. So. Any other points for the Bennington County CUD? I'll just briefly touch on Otter Creek. I think lately, Otter Creek is making some really good steps and exploring a lot of different directions. They're looking to hire additional staff. They are looking to establish a firm relationship contract with a construction partner and design partner. So I think that CUD is really moving in the right direction, and we'll continue to support them as well. I have made overtures to both CUDs to leverage that pre-construction grant funding, and I think that they are going to do so in the coming months. Especially Southern Vermont definitely has grounds to pursue that now, and we'll support them to apply for that. And I think that you'll be hearing from them for that funding soon. As for the legislative issues. The Cow Bill, based on the conversations last week, CUD support for that. Although we still haven't seen the final language of the bill and haven't announced our support one way or the other. I see our support for that bill waning, based on the rhetoric that's been aired in the last meetings, and it just doesn't appear to be going anywhere that is rational for us to support. So I'll continue to follow that, but I largely agree with Christine's assessment on that. I would like to thank Christine for her testimony regarding the budget and the funding. We're totally behind you there. We really appreciate that support. And with regard to the cell towers, we haven't formulated a position. Seems best just to keep a holding pattern on that from the CUD perspective. But if anything changes on position on that, you'll all be the first to know. So a couple of the so with regard to the shared services, yes, the municipal advisor and the bond council. I have talked with Rob about this previously. This is definitely going to be the next area of shared services that I'm going to try to put into place for Vicuda. It does look like this one may take a bit of a different shape. And like I mentioned, I'd like to evaluate that at Monday's meeting in terms of how CUDs would like to participate in this, whether it's, another of these as needed services or a more blanket, program that we provide. I'm open to either idea, and it's just a matter of where our member districts stand on it. I will say also that we are attempting to implement the as-needed model for accounting and auditing services. Our RFPs for those are now out and are open during the month of March. A note on shared services that the VCBB requested us to examine with regard to marketing. I have explored this, talking with multiple CUDs about what this could look like from Vicuda. It was briefly brought up in our last meeting as well. There does not really appear to be an avenue yet for the association to provide marketing services across the state. The fact that each CUD has a very different strategy when it comes to marketing. Many have already implemented the entirety of what they consider to be their plan. For now, this looks like something that is pretty individualized amongst the districts. I'll continue to keep my ears and eyes open for opportunities that we can help out in that area, but as of yet, haven't found an avenue by which to scale up the marketing across the state. However, we have introduced a new association website with links to the VCBB and all the individual CUDs, and that has some interesting features. I hope you'll take a look at that, and hopefully that can become a nexus of information for CUDs and VCBB as we deploy our networks.
So Will, on the one thing on the marketing thing, a suggestion would be to reach out to Sean in Northwest. His background is very much into marketing, if you haven't spoken with him already.
Yeah, Sean and I have spoken before that about marketing and about those kind of services, and we have some we had some interesting ideas of how to do things on a statewide level, but we haven't come back to that in a while, and it was more about CUDs, all CUDs rather than individual approaches meant to increase take rate in specific regions. I'll for sure take you up on that, Rob, and be in touch with Sean again this week to see if he has any other ideas of how we can roll that out. I'll also touch briefly on the fact that the main subject of our last VCUDA meeting was on incidental overbuild and the desire of multiple CUDs to try to convince your board to loosen those restrictions or those rules. Ultimately, we have decided not to proceed with that mostly after some conversations I had on the issue with Rob and Christine. But I do want to note that there are some CUDs that are pretty concerned about how the overbuild rules will impact their bottom line. And I won't get into too much details of that because I know, the standard for what the board will look at is whether we can present, some real evidence of how our plans will be impacted adversely by the rules as they stand. I'll try to support the CUDs to try and provide that information where it is available. But I just want to note for the sake of what's going on in the minds of CUDs right now that that does take a prominent place. So I didn't want that to go unmentioned, although we're not going to issue a proposal on it at this point in time. As for what else is going on in the realm of CUDs, for the most part, CUDs are pressing ahead with their partnerships, trying to finalize contracts, pull applications, and of course, the detailed design aspect that your board has issued pre-construction grant funding for. So it's a pretty critical period in terms of doing this work to be able to get make-ready started and then construction underway. And now I'm seeing why I didn't make this note thorough enough. But back to the one issue that I wanted to touch on, which was the letter of intent. My going backwards approach missed this because of, anyways, the letter of intent. I am trying to figure out. So for context, currently we are working to make a bulk purchase of hardware, not fiber cable this time, but the nuts and bolts and cabinets and all those wonderful things it takes to build a fiber network. And the plan is going pretty well. We have a great lead on a consortium pricing scheme that will hopefully reduce prices and possibly lead times as well, and allow CUDs. And I will note that we think we'll be able to get Waitsfield, Champlain Valley, another eligible provider, to participate in this as well, to optimize purchasing of materials in every front. What I have not been able to figure out yet is whether the letter of intent will be sufficient for this supplier. My assumption, without having the final word from their corporate, is that it will not. Based on the fiber purchase that we conducted, the level of scrutiny for the assurance is pretty high from suppliers. I think that is especially so given the demand. They have lots and lots of people who are looking for these supplies. We have a real advantage in that we're able to scale these purchases up across the state, but the evidence that we can be accountable for those purchases still will have to be in place. So I would request the VCBB to continue to look at that letter of intent more as something like a grant anticipation note. I am aware that the letter of credit is probably out of the question, considering the way that your board is structured in the legislation. But when it comes down to it, the lead times are maybe one of our greatest threats right now. The fiber lead times are going to cut it very, very close for the construction season. And the hardware times look like they will as well, especially given the uncertainty in the supply chain, global markets, coronavirus, and so forth. If we are able to find a way, facilitated by the VCBB, to utilize our grant funding, the sooner the better to purchase these materials, that will be absolutely critical. We were able to get this phased construction process implemented in the construction RFP. If there is a way to push those phases forward so that there is a purchasing phase or a payment phase for purchase materials, that would be absolutely critical for us to be able to secure those materials sooner, reduce the lead times, and also the way we see it, the sooner we can get materials now, the pricing will be lower as well. On that note, I'm almost dreading bringing this to the CUDs, but we're going to have to make another fiber purchase very soon as well, because if we don't purchase more fiber now, we will likely not be able to get any more during the year 2023. And our current purchase is expected to be finished by the end of 22 or by the beginning of the construction season in 2023. So we're going to have to purchase more fiber now as well if we want to continue construction continuously throughout the 2023 season into 2024. So I would just urge the...
Will, let's take a pause here. Holly has her hand up.
That's all I have to say to that.
Okay, take some Q&A.
Will, thanks for your comments on this. The way I heard you was that the letter of intent that we had proposed wasn't going to be sufficient no matter what.
I haven't confirmed that, but the letter of intent, I forgot to say, we do, the CUDs, I think would really appreciate this letter of intent to be approved by the VCBB. As Rob alluded to, or it might have been Patty, I apologize. It would be beneficial just for brokering talks with certain suppliers, just to be able to show that, a letter that this CUD is a pre-qualified by the VCBB. That would be a help, but I haven't been able to confirm that, and I apologize. Holly, please continue.
Okay, so the other solution that I hear you proposing is that we create a faster grant approval process and just plain go to market sooner. It would be interesting to know from staff's point of view, not at this meeting, maybe at next, what it would take to do that. And maybe the chunks of grant money given out would need to be smaller. Maybe the CUDs aren't ready for a faster program. I don't know. But that's an idea you propose, Will, that I think is worth looking at. And I also wondered, Will, if you could comment on why there isn't just a purchase of some of these necessarily long lead time items through the same mechanism that's being used to purchase fiber.
I do see Rob has his hand up. Rob, can I quickly respond to Holly here? So yeah, that idea of trying to push up those phases or fast track those phases of grant funding is one. However, a firmer letter of commitment or a grant anticipation note, I believe, also would be stronger than this letter of intent. As for using the same mechanism, I am exploring that as well, and that is the go-to plan right now, is to try to use the same funding partners and the same letters of credit to copy paste the last partnership we did and try to put that through for hardware. However, a way that is any way that we can leverage the VCB funds more easily, more directly, would be more beneficial, especially going forward, as CUDs will find more niche purchases they have to make that we can't really scale up across the entire state. if they're able to have a mechanism by which they can leverage funds quickly, maybe in advance of having their next phase of the grant in, that would be really critical to us to help beat these supply chain issues.
Yeah, well, one of the things I want to plant a seed for you is to help us help you, which helps the CUDs, obviously, with the grant anticipation note. We are trying to balance giving you funds and giving you commitments now so that purchases and hardware can be purchased with accountability and making sure that we're giving out funds appropriately. So we have some pullbacks on our side that we're trying to balance. So if you can help us figure out a pathway forward that we're just not namby-pamby making commitments without any due diligence put in front of us, that's the tough part right now. It's like we'd love to do it, but it requires a lift on the CUD's end as well. I don't know if that made sense, but I understand what you're requesting, and we want to lean in on that, but somehow we have to balance it where we can't pre-commit without the necessary guarantee, the necessary paperwork in front of us to say this is a viable project. These folks know what they know what they're doing, and we're not putting money at risk.
Yeah, noted, Patty. I would like to explore ways that we could provide, that assurance to the board. Of course, we're trying to do our designs and planning as thoroughly as possible to show that we, are going to follow through on making effective networks. I'd also like to present another idea of why the board may want to back this idea. Is that perhaps the board can find a way to ensure themselves of the success of the purchase by finding a way that, what I'm getting at here is that we need to bring these materials into the state. If the VCBB wants to achieve its goal, it's going to have this hardware. It's going to have the fiber cable. If there's any way that the VCBB could be reassured by the fact that these materials are 100% going to be necessary, even if not by a given CUD under a given plan. Maybe that's a bit of a nebulous idea for now, but if you see it all where I'm getting at, it's that these materials are going to be necessary to complete the VCB's project, whether it's from one CUD, from another, or from any provider.
Will, let me ask this really directly. Would the idea that Holly put forward of, rather than the letter of intent to provide, that we state we have earmarked X number of dollars for each CUD, fill in the blank of the CUD, and it's contingent, the allocation is contingent on a viable business plan and meeting the requirements of the grant application. Would that work?
I mean, from one vendor to another, it may work, but based on past experience, there's some need for a guarantee that funding will be received, and I'm not sure whether that would provide it. I.e., there has to be someone footing the bill, which is why we've gone for a letter of credit in our past purchases.
Okay.
But I also can't guarantee there wouldn't be some vendors that sign up upon knowing that that funding has been allocated. Trying to learn more about the market each day.
All right, Rob, and then Christine.
Sure.
And then Laura.
So first, there was some step above a letter of intent that was an option. I don't know if it was a pre-grant agreement. I cannot remember the term offhand that we could explore with. We could explore with Guidehouse. It was a lot more work to do, but there still is another avenue. In terms of providing funds after someone goes through the pre-application process and agrees to certain things, I don't believe it would be a massive change for us to do that if it's something the board is capable of. A final thought is, so many of these items, the nuts and bolts, for instance, they're commodities. Could the commodity itself be the backing of a letter of credit, since they could easily be resold on the open market? Like that's one other thing I
Great
ask
question.
that you explore, Will. There's also the potential that we explore it too. Like the BGS does have a waiver for commodity contracts that we could explore to see if we could lock up some of those commodities sooner than later.
Essentially what I was getting at, yeah, in not as concise terms.
So it's more of just where the board wants, though. Does the board want us to investigate everything or certain things? Like we don't want to get too far ahead of the board on this, since this is something that will take time to look into.
Yeah, and I'll piggyback on that. I think it's our job, staff, to come to the board with a recommendation. You know, I was actually, you know, when Holly talked earlier about administrative procedure, that's where I was going with that. I think the board will reasonably support, you know, something that we can bring forward that's specific and clear. But this discussion has been very helpful to understand what some of the parameters of what we need to bring forward with. So what I'm going to recommend is that we go back, we work with VCUDA, and we come back with a recommendation. As what was very helpful to hear from you, Will, was that, hey, you know, this letter may not, if the letter's not going to help you, let's come up with something else that will help you. And we've got a bunch of ideas on the table here, but I would recommend that, you know, we table this conversation and we come back to you with a suggestion, you know, pending there's some other comments. I'm just saying,
Yeah,
we can wrap this up and.
Completely agreed, Christine. I do want to reiterate that the letter of intent would be helpful. I mean, any resource by which we can, you know, market the buy-in that we have from the state of Vermont is helpful. I just don't know if it will stick the landing when it comes to purchases, and have some doubts when it comes to the one we're working on now. I'd really like to work with the staff to try to find a consensus proposal where we can say, you know, this is legal, this will get the job done. You know, this is a tool that the board can give us. And I think that we should put that into practice.
Okay, Laura?
Yeah, well, I had a question earlier. You were talking about the need for, oh, now I'm going to miss the language. So some variances amongst the CUDs in terms of nuts and bolts, I think is what it was. Some, you know, specific pieces that weren't going to be something that was needed around the state without, you know, creating any problems for the CUD. Can you just give me an example of something like that?
Laura, I'm not sure I understand your question. You mean materials that one CUD would need and others would not?
Yes.
I did not mean to. I think I may have miscommunicated that. We actually are seeing pretty strong consensus amongst the CUDs that they need the same materials from the same providers, which has been a really good thing.
Okay.
It also looks like our purchasing arrangement for hardware will allow for a good amount of flexibility for CUDs to pick and choose from a supply list that we get a discounted rate on. And when we negotiate with the supplier, try to get a lower level of commitment as possible, so that CUDs will have the flexibility to respond to their design and construction partners where other materials are necessary. I don't see a conflict in material needs emerging as a major issue amongst the CUDs, which is a really good thing.
Okay, that would have been my expectation. That's why I was asking. I was like, oh, that's interesting that someone's got unique kind of network.
So far, pretty consistent across the board.
Okay, and then the second piece with related to purchasing additional fiber. Can you give me the for dummies version of what the obstacles are for you being able to do that?
Well, you know, the real obstacles would be, you know, it's a pretty big commitment for a huge amount of money. Our original purchase of fiber, I can't give you the figure off the top of my head, but it's, you know, millions of dollars that we committed to. One potential obstacle is strand counts. Most CUDs, I don't think have designed far ahead enough to know exactly what strand counts they're going to need yet for 2023. This is not that big an obstacle. We can make projections. We can get what we think we need. The biggest obstacles will just be not as much putting the agreement through again, provided our funding partners are willing to step up further. It's just a matter of the amount of money it takes and the commitment it requires. But I don't anticipate huge obstacles to making another fiber purchase beyond those.
Okay, great. Thank you.
Yeah, I think it's unclear in terms of the capacity for the original partners to continue down that path. But you and I can talk about that. There might be other additional partners that would like to get involved.
Good point. Yeah, I mean, if we can replicate the same thing with other groups around the state, that would be great as well. I mean, and then Laura, I mean, maybe I should have said this before, but I mean, the lead times are pretty big. I mean, the only reason I'm talking about this now, when we have 2,000
Right.
miles of fiber coming to the state, is because.
And that's my question. That's really the basis of my question. With those lead times, you know, it seems like it seems like it's probably a good idea. And so what are the things that we need to overcome in order for that to, what are the things that CUDs need to overcome in order to get that moving?
I think that,
and I'm hearing Rob say partnerships is one,
yeah,
strand counts is another.
Yeah, the strand counts thing is just a matter of CUDs being able to make projections. I haven't really started those conversations with the CUDs yet about what they need after this current supply, but I don't anticipate that being too big a problem.
Okay,
I'm all
any
set,
other-
Patty.
Okay, thanks, Laura. Any other questions of Will? And I do just recognize that we have some hands up from the general public and CUDs. We're going to take public comment the next item. So we'll open it up there. Any other comments, questions from staff or board members?
No, we're all set here.
Okay, thank you very much, Will.
Thank you.
Right, and then next on our agenda is the public input section. Rob, can you lead us through that?
Sure. The first person is Ray Pelletier. You are up. You can unmute yourself and turn on video if you would like.
Thanks, Rob. Can you hear me?
We can hear you.
Okay, so I heard three things with regard to making purchases. One was the bulk buy, where we got a letter of commitment of some sort that a vendor might be interested in giving us funding or providing enough comfort for them to do an order based upon the fact that we have a letter. The second was that we have a letter of commitment, a letter of intent, a letter strong enough that enables us to go to a bank and get a grant anticipation note, issue a grant anticipation note, so that we can get a line of credit from a bank. And grant anticipation notes are authorized under the statute for CUDs. And if we could get that, the interest rates on those grant anticipation notes now are around 2%. So we're not talking, the money is cheap, but the price of the goods is rising and is going to rise even more. The third thing I heard, which may not be a bad idea, is that under the RFP construction grant, we submit a grant application for materials, period. I've been talking to our designers that we've been working with, and for 200 miles, it's going to cost us $2 million in materials. Now, that's just a swag of what we are going to build in 2022. And we'll be looking at getting materials further into 2023, not just 2022. But if we could put a grant application in for that, we know at CV Fiber that with our 9.3% anticipated money that we're going to get somewhere around $25 million. So yes, we put a bill of materials in for $2, $3, $4 million. You're going to wind up giving us that money at some point in time. And so that we do an expedited process perhaps on that. Very low weight, right? Not a heavyweight application for materials. So those are the three things I wanted to mention.
Great, thank you, Ray. Next up is Steve Huffaker from Maple Broadband.
Got to do here. So To a lot of what Ray had already said, we've done some investigation into cable purchase because I share what Will has expressed. We're going to be up against the same challenge, assuming we get what we need to get for our 2022, 2023 build. We're going to be running against the same issue. Lead times are 50, 60, 70, 80 weeks right now. Most distributors are claiming force majeure. So one of the other variables that I'm really concerned about is that, for example, we could put together a competitive bid right now. All the bidders likely are going to inform us that the prices are subject to change. And that makes sense, inflation. So sometime between now and when we actually receive the materials, that's going to become more expensive. So I'm worried that we may not, ethically, we may be constrained by saying, well, we're going to award the bid to distributor ABC for these materials, but we're going to be willing to pay more by the time we receive it. I don't know whether that's permissible. So that's kind of my biggest concern there. I'm less concerned about strand counts. I think we can project pretty much what we're going to need in terms of strand counts. I honestly think that the biggest concern is how do we work our way through force majeure so that we can get the materials we need and not run afoul of what VCBB's expectations are. Thank you.
Okay. Do we have anybody else?
Rob, Holly, do you have your hand up?
I do. I'm very appreciative of Steve Huffaker's notice to us of the practical reality of what's going on in the marketplace. And this force majeure piece is something that staff should propose a solution on. And I'm thinking that if you get a force majeure, something along the lines of you get a force majeure letter and your ability to pay for that component that's subject to an increase in price is, plus or minus a range. And as long as it's within the range, then having received the actual notice, the staff is just keeps going. But you all, Christine, could come up with an administrative process for that that recognizes the reality of the marketplace right now. We're building a bathroom at my house, and I'm experiencing the exact same situation. So I get it, but I think we don't want it to become a board level issue for every incremental ad. Thanks.
Yeah, duly noted. That's we haven't had the opportunity to do board policies, but that's typically a standard policy, right? A purchasing policy that's issued, but we can come up with something.
Okay, thank you. Rob, anybody else in public comment?
Nope, nobody. Nobody has their hands up right now. Is there anybody? Actually, there's nobody on the phone anymore, so nobody on the phone has a comment either. Going once, going twice. Public comment is over.
Okay. Next on our list is an overview of the parking lot.
Sure, I'll take that one. I'm going to share my screen here. Okay, can you all see that?
Yes.
Okay, so we basically, what I've done is I've rearranged it so that the items that are completed are below. We've got 5 items open now, and we talked about the benchmarks. I said we'd research, we'd come back with something on the March 14th meeting on that one. The commitment letter we just finished discussing, and we got more work to do on that. We'll pull everyone together and come up with a recommendation to the board. You heard Will talk about marketing collaboration. That ties to the other item, which will come back on the 14th. Material default. We're going to continue to work on that one, and the dashboard it's all part of the GIS. And we're trying to figure out how to incorporate that with our GIS system. So we're going to present a proposal probably the end of March on that one.
Okay, Holly.
The way I'm going to the statewide marketing collaboration, the way I heard Will's comments, asked and answered is the phrase they use. You asked Vicuda, the Vicuda membership said, no, they're not interested in collaborating on a statewide marketing program. I think what we might do is think about whether VCBB needs to do something in terms of promoting what's happening in the world of CUDs and the construction process, or give some visibility of who these folks are, if that's of interest to us. But I don't think you should keep this on your parking lot because you got a result.
Yeah, thank you. Good point. Happy to shade it out. Any other questions on the parking lot? Okay.
Right. Hearing none. Next item on our agenda is executive session. Do we have an executive session today?
Yes, we do.
Okay.
We'd like to talk to you about, first of all, some confidential issues that, early release would cause harm to the participants.
All right, I'll make a motion that we move into executive session as premature disclosure and general knowledge would place the VCBB at a disadvantage. Do we have a second?
Yes.
Okay, we have a second. All those in favor say aye.
Aye.
Aye. Any opposed? Okay, we will exit this meeting and resume in executive session on the other link, correct, Christine?
That's correct, yes.
Okay.
See you all on the other side.
All right, signing off.